Sensex will touch 1 lakh by the end of the year. Well, it's not us making this bold prediction, it's coming from none other than veteran investor Mark Mobius. Now that's about a 20% rally from where we stand today. So for context, the benchmark is currently up about 16.5% in the first 9 months of 2024. So Mark Mobius is essentially expecting another 18 to 20% rally in the next 3 months. For those who don't know who Mark Mobius is, he's a legendary investor with decades of experience in emerging markets. He's been a big believer in India's growth story with significant investments in Indian stocks over the years. Now, according to Mobius, the journey to the coveted 1 lakh mark may have some bumps along the way, but he's confident that these challenges will only have a temporary effect and the bull run in Indian stocks will power through. But should we share his optimism? And what are the factors that could potentially derail this extraordinary rally? To help us break it all down, we are joined by Gaurang Shah, Senior Vice President at Geojit Financial Services. Gaurang, thank you for giving us time here on News9. Now, Mark Mobius, he is expecting Sensex to hit 1 lakh by the end of the year. We are currently at about 84,200 odd levels. So he's essentially saying that Indian markets could perhaps rally another 18 to 20% in the next 3 months. Too optimistic?
So even if I take calendar year end December 24 or financial year end March 31st, 25, I think it looks to be a little bit more optimistic in terms of expectation from the markets. Of course, Mr. Mobius is well known for whatever work he has done and the advices that he has given out, especially with respect to the emerging markets. Not countering his statements, but we need to be also a little bit within the expected lines, Suyash, given the kind of global events that are unfolding. Unfortunately, I'm referring especially to the geopolitical situation. Any escalation over there will lead to any escalation over there, I'm referring to the situation, especially in the Middle East, because crude oil is one of the most important commodities across the globe, especially for emerging markets like India and China. So any kind of disruption over there or any kind of escalation would lead, and if it has to lead to the boiling crude oil prices, then definitely we have things to worry on our hand, at least from immediately short to medium term. But notwithstanding that, I am absolutely on the side of Sensex going towards 1 lakh. Matter of time, Suyash. I'll just give you one simple number. Even if you look at YTD returns of Sensex and Nifty, then as of today, if I'm not mistaken, I stand to be corrected if I'm wrong, it is anywhere between 70 to 80%. Right. I'm talking about Jan 24 till 1st of October today. It is 17 to 18%. And if I take 1 year returns, that is from October 23 to 1st October 24, then we are close to about 27% or little bit here and there, plus minus about 1 or 2%. Now forget all these things. Even if I take a very base case scenario of 10% return on Sensex and Nifty, then I think in the next 2 years we'll definitely be over there. There is absolutely no doubt about it. So I am with that thought process that yes, 1 lakh is achievable. But only thing is that there are a lot of unfortunate global events which are unfolding. There are a lot of stimulus that has been offered. People's Bank of China, we heard. And remember one thing, stimulus doesn't come free. There is also a cost at the end of it that that particular country has to pay. And there are things changing in Japan. I mean, for the last many, many years, we have spoken about negative rate of return in Japan. Now things are changing over there. So one needs to be a little bit cautious in terms of approaching the timeline of Sensex hitting 1 lakh.
All right. And, speaking of China, they recently announced a mega stimulus package, which has fanned fears that, foreign institutional investors will now adopt a buy China, sell India strategy. We saw some indication of it on Monday where they pulled out more than about $1 billion. Meanwhile, China's stock market gained a massive 25% in a single week. Is this something that you're concerned about?
You're talking about China, the stimulus over there yesterday selling in the market and investors wanting to fly to China now. To be very honest, because too much of liquidity in our market is also not good. Of course, now there is a very different scenario, Suyash. I'll just highlight 2 points over here. since last year and this year beginning, we have multiple IPOs hitting the street. New paper coming into the market via IPO route. Good papers with good valuation, sound business, and great management has got oversubscribed 2x, 3x, 4x, 5x, or even more. So there is a lot of liquidity. Earlier, the thought process was that if there are large IPOs coming and hitting our markets, secondary market will see a sell-off, and liquidity will start flow into primary markets. Nothing of that sort happened. Primary markets is going at a good run rate. Secondary markets are making lifetime highs, to be very honest with you. That's point number one. Point number two, compared to last year and the year before, this year we've seen a lot of block deals happening. Either promoter wanting to sell off, or parent company wanting to sell off, or large investor wanting to sell off. All those bulk or block deals get finished off within the first 30 seconds or 1 minute of the market getting opened. What does this tell you? There is enough liquidity in the market. This is happening when FIs were selling. Suyash, I'm not talking about FI money coming. So let's be honest to ourselves. And even last month, if you actually go to see, I'm talking about not September, but month of August, net FIs were sellers. So I am not surprised with that sell side figure. And there were multiple factors, Suyash, yesterday why we saw the sell off. There was SEBI board meet. There were expectation of certain restrictions being put in place because of the losses that retail traders have incurred because of unexperienced and ill-advised trading in puts and calls. We all know that. We also had an overbought situation in the market, 26,200 and above. For me, it is a little bit too difficult to digest. And this correction yesterday we saw was after 10 days of rally, Suyash. So I think we have to give it to the markets. One-way direction is not at all advisable, either up or down. It has to be a balanced approach. So FI is going into China. Well, they are more than welcome, to be very honest. We have enough power, liquidity power with retail investors coming in and with domestic institutionals war chest of cash that they have. So I think we are ready for any eventuality in case if FI has to go and fly to China.
Now, SEBI did not announce any curbs on the derivatives market in the September 30th meet. Nonetheless, curbs are expected. Now, SEBI has also floated a consultation paper, a couple of months back, which recommended raising the minimum value for derivatives contract, single weekly options contract per exchange. If these measures do come into effect, will this lead to a correction in the short term?
I don't think so. And even if that correction has to come, it will be very short-lived. It will be for that particular month. I don't know. There were talks yesterday or rumors in the market yesterday that white paper consultation paper was out. 7 changes were supposed to be bought in. It did not happen last evening. Maybe it might happen in the near term. That's what even I'm hearing. As and when these changes or restrictions are put in place for that particular short to medium term and the immediate month's contract, you might see volatility because positions have to be, you have to wind down upon your positions. You can't keep it open because that possibly from next month onwards, you will not have that. And, having this weekly multiple expiries also leads to a lot of speculative approach, and it also leads to a lot of volatility. So, and more importantly, I think these steps are taken or will be taken by SEBI only to make a lot of transparency and bringing in regulation and making it discipline. Suyash, you must have also heard about the number that the state-wise retail traders have lost. I mean, it's humongous. I think it is first 3 states are Rajasthan, Maharashtra, Uttar Pradesh, followed by Gujarat, if I'm not mistaken. I was reading a report, and the figure is some 50,000 crores plus, if I'm not mistaken. Again, correct me if I'm wrong. So when this kind of money a retail participant is losing in ill-advised, and I'm absolutely against this so-called unsolicited universities of Google, WhatsApp, X, Y, Z, Twitter, whatever you want to call it. So people get swayed by it. Unfortunately, people don't learn, but I think it's a good move. We need more disciplined investors rather than ill-informed traders, Suyash.